Okay, here we go. Welcome to another video for Pay Stocks, your trading friend. So in these videos, I go over major changes I'm doing to my portfolio, typically about the economy overall, namely the S&P 500. And this is my website. I always invite you to join the website. You can join the newsletter here and read my articles about new initial public offerings I'm getting involved in, as well as new changes I'm doing to the S&P 500. A couple good things you can read here is the S&P 500, how you can outperform most financial advisors. And another one's a little bit on cryptocurrency with Cardano. Give my opinion on what stocks to look at, what cryptocurrencies to look at over in the crypto market. And a lot of good stuff as new IPOs come out, periodically. And you can also see the portfolio as I make changes and update this, which I will have to do after this video. Because what this video is going to be about is why I'm going out of my SPY position and into an SPXL position, which is the leveraged 3x ETF, a 3x leverage ETF of the S&P 500. So when the S&P 500 goes up 1%, the leveraged ETF goes up 3%. So with that being said, I am expecting some rallies coming. Before I get into that, and since I just bashed financial advisors a little bit, I need to actually support them too. Because this video is not really about me providing financial advice. It's really about just my opinions of the market, what I'm seeing out there, and how I'm choosing to capitalize on those expected moves. Now, with that being said, I always encourage people to get some financial advice from a financial advisor that can help you make a good foundational financial plan to reach your goals and your retirement. And once you have that, you can then learn some information from the internet, books, my videos, and increase those results. But it's advice is not what I'm really trying to do here. And yes, so anything you do, based on these videos is definitely at your own risk. So I mentioned that. That's my little disclaimer here. Now this video is about the S&P 500. Let's go to current. A lot of things happened these last few weeks. I'll just start off though. I got into this leveraged ETF position on November 3rd, right after it hit an all-time high. Well, the S&P 500 was hitting all-time highs for a little bit now, but right after the Dow Jones Transports hit an all-time high on November 2nd. Now, what happened on November 2nd, Avis Budget Rent-A-Car, which is one of the companies in the transportation index, closed above 100%. They had an earnings report that just blew away expectations and caused a really strong rally in that stock, which, since it's part of this index, caused the Dow Jones Transportation Index to hit new all-time highs. Now, since we're seeing the transportation index hitting all-time highs and the S&P 500 hitting all-time highs, as well as the NASDAQ, another broad market index, and as well as the Dow Jones Industrial Average, another broad market index, this triggers what's known as Dow theory, which I've definitely talked about in several videos. It's one of my favorite principles and theories of investing. What it kind of states is that if the transportation companies are doing really well and kind of expecting a lot of business, which with all the supply chain concerns going on the coast, it makes sense. If they have someone to drive a car or unload a boat, they have the business. There's plenty of business right now for them to choose and raise their prices, raise their revenues, raise their earnings. The transportation companies is a great industry to be in right now. And we're seeing the overall economy doing pretty well as well, since the S&P 500 is at all-time highs. When these two things align, we can, according to the theory, expect higher highs and a continuation of this rally and a continuation of hitting newer all-time highs. Since the transportation companies are expecting and are capable of moving a lot of raw goods, and the S&P 500 companies are selling and using all those raw goods, this is a great perfect storm to go on and continue. It's saying that transportation companies have a lot of business right now, a lot of stuff, raw and finished goods to move around, and the S&P 500 companies are buying those raw goods and selling those finished goods. So there's a lot of good business going on, a lot of rises in revenues, a lot of rises in earnings, which is what you want to see for S&P 500 values to go up. So that's one good strong thing going on. The other good strong thing is the bond market. One of the biggest concerns right now for investors is rising interest rates, but the bond market is predicting that interest rates won't rise. Since they dropped here and found some support, they went back up, so got rejected from going lower at a pretty good strength. These are pretty strong days for bonds. Then it tried to drop again, found support at the same price level, and got bought back up with some good strength. Then tried to drop again at a higher, and found a higher support level, and got bought back up with some strength. So there's people willing to buy bonds at this level. They're not going to collapse. And when bond prices go up, the interest rates that correspond to them go down. And that's going to signal that the federal interest rates will continue to be where they're at or even go down. Probably not go down in this case since they're already at zero, but at least they won't rise with any sort of major strength. If they were to rise, then you'd see these bond prices going down a lot. Now, when the stock market was having some turmoil in late September, early October, we saw these bond prices rising, which signals higher interest rates are possible. But then it found some support, and the stock market's kind of recovered since then, and is hitting new all-time highs, as I've said. So bonds look good, and so that's another strong thing going on. So we got Dow theory, a good, healthy bond market. And now we also have the yield curve going on over here. So the yield curve is, I've definitely mentioned this as well in a past video. We don't want to see a yield curve that's flat like we did in 2019. Flat yield curves kind of predict a stock market crash or even a recession, as this website kind of points out. The last time we saw a flat yield curve was 2019, a few months before coronavirus started, which is the most recent recession we've had, most recent major stock market crash we've had. So it predicted that there's some weakness in the stock market, and it was profoundly right for sure. Since then, this other line, this gray line, is from 2020, which was one of the strongest years in stock market history. And that is a nice upward sloping yield curve, which is what we want to see. And then since then, we're in 2021 now, which is this blue current line, and that's an even stronger high sloping yield curve up. So this is what you want to see for a healthy market, and it is what we're seeing right now. So that's strength point number 3, which is leaving me to get into a SPXL position, which I did on November 3rd, right at the open. I really was supposed to get into it November 2nd, but I just missed. I didn't notice the Dow Jones transports that hit a new all-time high. Just wasn't watching it, unfortunately. Saw that at the end of the day and got in next morning, which actually was a slight bit better. Actually got in about 0.1% under what it closed at, so got that little extra. And since then, the first day went up 1.8%, next day 1.3%, and as I'm filming this, it's up about 1%. So I'm doing like 4% right now for 3 days, not bad. My target though with this would be closer to like 20 to 30%. So I got to see the S&P 500 go up another probably 6 or 7, I think, from where it's at right now. So it's got a little ways to go, but I'm watching it. My signals to get out of this, if things start to deteriorate, is a 5% drop from the close of this day, which from the close of the all-time high sort of day. Usually I go off of the wick, but this wick, since it was kind of like just a random sort of, not random event, but like not something you'd expect to happen all the time. I'm not going to choose to disregard the wick because this actual all-time high, the top of the wick to where it closed at, is already 5%, so it'd actually be out of the position according to that. So I'm just going to go off of the close, which is 17,039. If the stock market, if the Dow Jones transportation drops under 5% of that number, the 17,039 number, then I'll exit this position and go into SPY non-leveraged. Or if the SP 500 drops 5% from its all-time high, which right now is 47.19, then I'll again leave my SPXL position and go into just SPY. So that's how I'm playing that. The things that I'm watching for any sort of coming turmoil is definitely the dollar right now, and also what the Federal Reserve is doing and jobs reports. So the dollar has shown some strength as of late. It's got a pretty good upward trend going for a while. And it's been going up, I guess, since January 2021, you could say. And every time it kind of drops, it comes back up to another higher point, drops, goes to another higher point, and so on. So it's obviously got a lot of ups and downs, but it's been definitely going up. There's some strength you can see here. I've definitely mentioned in a few videos kind of how like the dollar value works. The way I usually illustrate this is if you have a loaf of bread and currently it costs $10, if the dollar goes up in value, then that same loaf of bread should be able to be bought for less than $10, more like $9. If it goes down, because each dollar buys more value, more bread. Now, if the value of the dollar goes down, then the loaf of bread should cost $11 because each dollar buys less bread. And that's what typically inflation is known as, when each dollar goes down in value and buys, less bread, less assets like stocks, gold, bread, toilet paper, what have you. The biggest reason why this isn't the biggest concern right now, though, is because the dollar is affected by a lot of things, mainly what the Federal Reserve is doing and what our economy and politics are doing, but also what the European Central Bank is doing, what the Chinese Central Bank is doing, what all those global currencies are doing. Say the United States has been staying the same as far as economics go and Federal Reserve rates go, but the Europe is in really bad shape and their dollar, the euro dollar, is going down, then our dollar will go up despite us not doing anything. And vice versa, if the euro was going down, then our dollar was going up, the euro was going up, then our dollar would go down. And again, not because we did anything, because Europe was doing strong. And same thing with China. If the Chinese yuan, their dollar was going up, our dollar would go down in correspondence to that. And vice versa. If their dollar goes down, our dollar would go up. Because it's a big, global type thing. The dollar is affected from global markets, not just what's happening at home. So yeah, watching the dollar, and right now it's not the strongest sign, so it's kind of one in the negative column. I'm also watching what the Federal Reserve is doing. In their last Wednesday meeting on November 2nd, they announced that they're going to cut back on how many bonds they're buying and how many mortgage-backed securities they're buying. Currently it's at $80 billion in treasury bonds and $40 billion in the mortgaged bonds. They're going to cut that by $10 billion for the treasury bonds and $5 billion for the mortgage bonds. Now, they've been giving unprecedented support for sure for the stock market. If they cut this back by $10 billion, they were still giving unprecedented support for the stock market. And same thing with the mortgage bonds. This is actually, I think, the first time in history they've ever been buying mortgage bonds as the Fed. I think in 2008, the United States was the one who bought the mortgage bonds. But anyway, if they cut that back by $5 billion, $35 billion buying in mortgage bonds every month is still a lot of support. So while, yes, this is a concern that they are tapering this back, it hasn't crossed that threshold yet of where this is a concern, and it's below that threshold of where it's not a strong support for the stock market. The Federal Reserve is definitely still supporting the stock market. And they also mentioned that they're not really planning on raising interest rates for some time. I think late 2022 or mid 2022. Don't think I actually found it in this article though. But that's going to go talk about it on this next bit. The biggest thing that they watch for when they raise interest rates, the Federal Reserve, is the jobs reports and a lot of other economic things like inflation with CPI and PPI reports, but those are much less weighted than the jobs reports, the non-farm payrolls here. This is definitely the biggest factor for when interest rates will rise and fall. So what we saw just this morning, Friday as I'm taping this, was a non-farms payroll number of 531,000 new jobs being made. They expected 450, so they beat their estimates. And we also saw some revisions from September's report and August's report, which is down here. Now, September was a huge miss on what they expected to make in jobs, new jobs, and they revised it up to from 194K originally up to 312. So added a nice 100,000 jobs, which makes it still a miss on the estimates, but now it's like more of an acceptable miss than just completely not even close like it was originally. And the August number, which was also a huge miss at 117,000 originally, got revised way up to 483. So they added 360,000 jobs to that number, corrected it. So that at that point, I think they were expecting around 500 as well, or maybe 450,000 for that month, and it's about in line. So two reports, August and September, which originally were abysmal and horrible misses, have now been revised to only slight misses to almost in line. When jobs reports are missing their estimates, this kind of signals to the Federal Reserve that they can raise interest rates, that the economy is not healthy. Now that these have been revised to more in line to only smaller misses, it's showing that to the Federal Reserve, the economy actually, it does have some health to it, which can signal a green light to raise interest rates. Because this is the biggest thing they're watching. They want a strong job market. So this is the first initial jobs report that actually came out stronger than the estimates, and the other ones are now revised to be a little closer to where they should be. If this trend continues, then this might signal that the Federal Reserve will raise interest rates a little sooner than it kind of expected. And right now, like I said, it's expected to raise, mid to late 2022. If that gets moved up to early to mid 2022, then we could see a crash in the stock market being a lot more potential. But not something I'm concerned about just yet. So yeah, keep an eye on the dollar, seeing if this starts to rally out of control. Keeping an eye on Fed tapering to see when it crosses that threshold of, right now they're still supporting it pretty strongly, but at some point it's going to cross some threshold where like the support's just not enough to keep prices elevated. And keeping an eye on the jobs reports, because if this strength in jobs creation continues, then that'll lead the Federal Reserve to raise interest rates, which will signal that the party of cheap free money and low interest rate loans is over, and which will cause stock prices to typically drop. And that about does it for my stock report. And yeah, I think it's going to end it here. Other than that, again, if you liked the video, found some useful information, like it, subscribe so you can get notifications when I do post these, and sign up to the newsletter. This way, one, you can get emailed when I post anything like this. When I make a new IPO trade, like this last Vulcan trade, right now this is up over 50 to 60% and has risked off, by the way. So I made the money that I put in my initial investments already off, so I'm at a no risk trade, and it's up 50%. So this was a great trade so far. You can also see my portfolio. So yeah, a lot of good stuff that's on this website, plus a couple bonuses too, so you can make a couple like bonuses on your credit cards, your brokerage account, personal capital, wealth tracking, a lot of stuff like that. And one last thing, to read all of this stuff, you do need to sign up to the newsletter. As I mentioned every single video, I always put up a disclaimer. So when you sign up to the newsletter and try to read these blogs, I need to have you accept this disclaimer. I need to know that it's on record somewhere that you understand these are just my opinions and not me giving you financial advice on what to do with your money and how to reach retirement and stuff, because it's not that. It's just my opinions and what I'm doing. And that'll about do it. So I will leave this video here, and everyone stay safe out there and happy trading.